Joining us now from Singapore is Fereidun Fesharaki, who's a founder and chairman of international energy consultancy group FGE. Fereidun, great to have you with us as always. Let me start it off with a quick chart as to how they've done so far, right, with these curbs. 3760 mission almost being in the process of being accomplished. We have seen inventories, global oil and product inventories shrinking since these cuts began, and we did see a pickup when it comes to prices as well. You know, this deal, which the market expected, which the market wanted, is it enough to keep pushing market participants to rebalance?
I actually think that the market is already in balance. The concept of the 5-year average inventory is not really a very sound concept. When OPEC reaches the 5-year average, I think the prices will be in the range of $65 to $70. And this is one thing which made the Russians very nervous, that they think the price of oil may be going too high, too fast, and that will bring in competition. So actually the market is already in balance today.
Were you surprised by the very united front that was presented by the energy ministers of Russia and Saudi Arabia? I think the Saudi energy minister saying we stand shoulder to shoulder. Was that kind of level of allegiance a positive surprise, clearly?
Well, you know, the past year since December of 2016, this cooperation has been very good. Both of them knew that they had no choice. If they did not agree to the 9-month extension, the prices would definitely fall. The net longs in the market are at record levels. Everybody was very nervous. It would have taken very little to bring in the prices $5, $10 a barrel down. So actually they had no choice. They did what they had to do, and they did it very well.
What about the inclusion of Nigeria and Libya? I mean, that, I think, came as a bit of a surprise, again, a positive surprise. Are the implications significant?
I think it's quite significant. And one thing which did not really come out in the OPEC communique is about how much they can produce. As you would have noticed, they have restarted the clock, not from March of next year to the end of the year, but from January 2018 to the end of 2018. And this is why they wanted Libya and Nigeria to be subject to the agreement from next month. And that is why they reset it to start earlier rather than the end of March, as was expected before.
You know, we mentioned at the top that your view on prices over the medium term range from 55 to 70. Clearly, the days of $100 a barrel are clearly behind us. But I'm curious as to what kind of factors are you pricing into the lower end at 55 and the higher end at 70?
You know, we always say that the prices fell from $100 to $50, but actually the right way to look at it is the prices went up by double for no reason, and they came back to where they belong. So $100 was an aberration of 4 years. It was not really the trend. Now, what is going to happen this year with this existing OPEC agreement is that the prices are going to go higher than OPEC wants. $65 to $70 we expect the prices to reach as the inventories become smaller and smaller. So then they could either reorganize the agreement or they can start cheating, which I expect they will do. OPEC is very good at getting together when the prices are low. When the prices are high, OPEC and the Russians will find it much easier to produce some more oil. So higher prices today means lower prices in 2019. We're pretty sure of that.
At 65 or 70, what happens to US shale?
Well, just today, the news came that the US shale production increased by 140,000 barrels per day above what was expected. I think that there will be substantial growth. In the US, they don't look at the Brent market, they look at WTI. So as long as WTI is above 55, and today is around 57, 58 range, WTI prices will do two things to you. One is that you hedge 1 year forward, so you don't care what happens to prices, you produce maximum. And the second is that those projects which were not working, such as Bakken or Eagle Ford in the US, they all become active within 3 to 6 months. So there will be a price to pay. And I think this is why the Russians were hesitant and agreeing. The Russians say the prices are going higher. That means the prices will come lower. Let's keep it at a lower price. But OPEC and Saudis, they wanted higher prices, maybe because they wanted a higher price for the IPO that they plan to do. So the Russians had a good point in trying to moderate the price growth.
Yeah, and that's also kind of what I wanted to go into is does this environment where you have kind of maybe a Goldilocks price point when it comes to crude, does that set up exactly where the Saudis want to be going into the Aramco IPO?
Well, you know, for the IPO, they need about $65, and I think this is the right price for them to go in. But the financial markets, they can see that if you end up with a higher price now, you will end up with a lower price later. So the forward curves would factor that in. So I am doubtful whether the $2 trillion valuation that they want, they can get. But so far, the wheels are turning because the big boss in Saudi Arabia wants it to happen, and everybody is moving in that direction. If the circumstances change, they may reconsider. But for now, everything is still ready for the second half of 2018 to bring the IPO on.
We were just having a chat over the break about the potential for greater volatility and swings in the market, right? If compliance stays high and we're kind of in this situation for another year at least, do you see the potential for an interruption, say if there's some sort of geopolitical interruption that we haven't priced in, to be able to move the market really significantly?
The answer is yes, because as long as OPEC and non-OPEC stick with the cuts, the market is very tight. Any kind of impact on oil production, which before didn't seem to matter, now will matter. Let's say another big conflict in Libya, which cost the production by 500,000 barrels per day. Another major Boko Haram attack in Nigerian oil production, which reduces the production. That can lead to a substantial increase in the price of oil. If anything happens in Saudi Arabia, which impacts the stability, then the prices can go to the roof. So the market is now sort of, at the moment, tends to be volatile on the upside, as long as the cuts continue. I expect that if these things happen, then the Saudis and other people will produce more and dampen the price. But as it stands, it could be very volatile in the short term.
And the other, factor that could obviously introduce aggressive moves in the market is the idea of an exit strategy, right? I mean, they were questioned about this in Vienna and very adamant that it's too early to talk about an exit strategy. What would that, if it's a taper, if you will, if you're thinking about it in that way, what would it actually look like?
Well, exit strategy would look like this. Then when you get to September, October next year, you're close to the end of the year, then you start talking about phasing it down. This exit strategy cannot be coming in one go. It has to be phased in. And you phase it in by saying, okay, then we go from 1.8 million barrels per day combined cutback to 1 million. And then within a few months, we go to 500,000. But remember that as the prices go up, OPEC will start cheating. And OPEC cheating then would itself moderate the system by itself. So that would be a way of phasing out by looking at the cheating. As I said, OPEC is very good when the prices are down. When the prices are good, then the temptations would be much greater to produce more.